This is Chris Casey, Managing Director with WindRock Wealth Management, a unique wealth management firm combining a top-down macroeconomic perspective with an entrepreneurial mindset to seize on investment opportunities. I'm pleased to be joined today by Rick Rule. Rick is the President and Chief Executive Officer of Sprott U.S. Holdings, where he leads up highly skilled teams in science and composed of science and finance professionals in the resource market, including agricultural, mining, energy. Rick is a frequent speaker at industry conferences and in media interviews. Rick, thanks for joining us today.
Pleasure, Chris. I like being with you.
You know, if you look, a lot of people have written or spoken about the commodity markets and how being prices are throughout commodities, not just in depth, but as far as breadth. And looking at the energy landscape, it seems like perhaps it's even seen the most significant losses. I'm talking about oil, natural gas, coal, uranium. And I know you famously have said that the cure for low prices are low prices. Could you expand on that a little bit for the audience?
Sure, Chris. There's two ways out of a commodities bear market. The first and most common is demand creation. That occurs either as a consequence of a general economic recovery, where demand for the basic stuff of mankind, resources increases, or it happens as a consequence of the increased utility to consumers afforded by low prices. We're starting to see a bit of demand creation in energy now. As an example, gasoline sales in the US are pretty strong as a consequence of low prices. And natural gas demand is also strong as cheap natural gas prices begin to back coal out of the energy generation matrix. And cheap natural gas prices in the US are beginning to bring chemical fabricators back to the US burning natural gas. But what I think we're going to see this round is a different way that you come out of a bear market, and that's through supply destruction. Supply destruction happens when the unit cost to produce a unit of commodity exceeds the selling price. And that's certainly happening in the energy business right now. You mentioned uranium. Cameco, the world's largest producer, estimates that it costs the industry as a whole $65 a pound to make uranium, including earning the cost of capital back. So they make the stuff for $65 a pound and they sell it for $35 a pound, meaning that they lose $30 a pound, and being miners try and make it up on volume. Now, what they really are doing is cannibalizing the retained earnings in the companies that they either earned or raised over the last 10 years. And this sort of cannibalization can last until you basically eat up shareholders' capital. What happens during this period of cannibalization is that there's very little sustaining capital investment and there's almost no productive capacity investment. So as the mines decline, they aren't being replaced. And you reach a point in time where supply begins to fall very precipitously. And when the supply falls precipitously and the price begins to rise, you can't bring new supply into the market because you've already destroyed your productive capacity. This circumstance that we're talking about, supply destruction, was the author of the last uranium bull market that saw the price go from $8 a pound to a high of $120 or $130 a pound. You'll remember also that natural gas responded to those market stimulus by going from about $1 a thousand to a high of $15 per thousand. The bear market that we're in now sees almost every industrial commodity on the planet being priced at less than total production cost, which means over some period of time, and I wish I could tell you exactly when, that we are going to have a supply destruction-led increase in commodity prices and hence in the prices of the equities associated with commodities producers.
Well, let's drill down on a couple of these and kind of discuss that in greater depth. Let's talk about the oil market, because this is one that's in the media all the time. You know, from a little over a year ago, we went from above $110 a barrel to just over or around 40, depending on what price you're looking at. And here's where we probably haven't seen the supply destruction yet. It's on a worldwide basis. You know, it's still quite a bit of production out there. Where do you see that market is going? Do you see?
That's a particularly interesting market. Americans believe that we have a supply problem because American production has increased so rapidly. But increases in American production have been neatly offset by decreases in Libyan, Mexican, and Venezuelan production. What we have really is a crisis in demand. On a global basis, oil utilization hasn't really increased. And you're right, we haven't in the near term seen supply destruction based on levels from 2 years ago. Remember that I said that supply destruction is really a function of cannibalizing retained earnings. We estimate at Sprott that the global cost to produce a barrel of oil, including sustaining capital and earning the cost of capital, is around $60 per barrel. That's the cost. And so again, you're making the stuff for 60 and you're selling it for 40. This can go on for a while because the oil companies got so fat in the period 2002 to 2012, and demand is so flat on a global basis. But when I say it can go on for a while, it can go on for a couple of years, maybe even 3 years. My suspicion is that you're going to see the beginnings of a meaningful decline in U.S. production in the second quarter of 2016. Remember that when the oil price first fell, the assumptions on behalf of the oil industry were that we were going to see a V-shaped recovery. Remember also that credit was last year freely available in the oil industry despite the decline in prices. Remember further that many of the companies had very large sunk investments in land and seismic, which they would lose if they didn't drill wells to hold acreage by production. And finally, remember that many of these wells were drilled but not completed. We have, in the last year, done a lot of completing of these drilled uncompleted wells, or DUCs as they've been called. And this has helped us maintain production, and we've cannibalized a lot of capital. My own belief is that in the second quarter of 2016, the public oil companies in North America, both the United States and Canada, are going to have to report the net present value of their current proved producing reserves using something more closely approaching the current price deck. And the consequence of that is that almost all of them are going to have their credit lines reviewed. And most of the companies in the United States, I say most, like the vast majority, are going to have what's in effect a cash call. They're going to go from having a credit facility that is interest only and evergreen to a credit facility that doesn't have any increase in capital, where they're beginning to be turned out over 5 years or 7 years. What you will see then is a really precipitous drop off in fracking, refracking, and new drilling. And the consequence of that, after 6 months, we'll see the beginnings of a precipitous decline in U.S. production, particularly in the shale plays that have generated so much of the increase in production.
You know, oil is an area that we've held off investing in for some time on behalf of our investors just because we're concerned about economic weakness across the globe. But how low do you think oil can go in the near future here?
Chris, it's dangerous to give a broker the use of the word can. With sufficient incentive, I can give you any number that you want. Could we see $30 a barrel? Yes. What's interesting about that is that the lower the price goes and the longer it stays below 50, the higher the rebound is, because the more production you'll shut in. As an example, prices in oil below US $50 a barrel renders almost the entire North Sea uneconomic. If you took the North Sea out of production, you would eliminate 100% of the difference between supply and demand on a global basis. So the longer the oil price stays dramatically low, ironically, the better the rebound is going to be. From the point of view of consumers, a rebound of the oil price from the $40 number to the $60 or $65 number would be advantageous, because it means that 5 years from now, the oil price would be in the $75 to $85 range. If we have oil prices below $50 for the next 2.5 years, we'll see a circumstance where the oil price in 5 or 6 years is in triple digits again as a consequence of supply destruction.
Well, let's talk about a commodity that's not in the news nearly as much as oil, and maybe one that at least I haven't identified a catalyst like you have with oil for higher prices down the road, and that's coal. And I think one of the reasons it hasn't been in the media is because it's been so low for so long. Where do you see coal prices trending?
Lower in the near term. It's important, Chris, to understand that the coal market is really 70 or 80 markets around the world. The first division is, of course, met coal versus thermal coal, but there's also regional markets. So, as an example, high quality met coal in the United States has held in terms of pricing better because it's cheaper to ship coal from Pennsylvania to Pennsylvania than it is to ship coal from Australia to Pennsylvania. By contrast, thermal coal into the US market has fallen really precipitously as natural gas has backed coal out of power generation markets. So it's important, first of all, to note that the coal market is really a whole bunch of subset markets. It's also important to know, though, that the long-term trend with regards to thermal coal, that is coal that's used for the generation of electricity, in markets that can easily afford coal, markets like the United States, Japan, and Western Europe, is in fact lower. The demand for metallurgical coal, from our standpoint, probably bottoms out next year. You look at things like the global auto fleet, the age of the global auto fleet, and car side is going to be a fairly steady type of steel demand. So we see the met coal business bottoming out perhaps 2016, 2017. The thermal coal business looks a little more bleak. The only bright spot in the thermal coal side is Indian demand.
That's interesting. You know, a very similar market in some ways as far as the regionalism that you're talking about with various submarkets within different geographic areas is of course natural gas. Can you comment on where you see natural gas headed? I mean, it's amazing over the last couple of years. There are some countries that have seen a drop, namely the U.S., I think Germany as well. But in other areas, namely Japan or UK or France, it's up significantly. What are your thoughts on the natural gas market?
We see the natural gas market firming from here, if only because the price is so low that the utility to consumers is high. But natural gas is also a fairly efficient form of energy in terms of the calories per volume. One of the things that has strengthened the natural gas market, ironically, has been the decision by West Germany to phase out nuclear power. Ironically, of course, the phase out of German nuclear power has been met by importing nuclear power from Poland and France, but also, of course, from importing natural gas. The other thing that's interesting about natural gas worldwide has been the emergence of alternative energies. While the supply of alternative energies has increased fairly dramatically, the truth is that they're very intermittent supplies of energy. So, as an example, relying on solar energy has one very big problem: night. Relying on wind also has a problem, that when the wind doesn't blow, it doesn't generate. The consequence of trying to feed more of our grid on unreliable alternative energy means that you require more natural gas to burn to generate peaking requirements during periods of time when energy demand is strong, but the wind isn't blowing and the sun isn't shining. So we're very constructive towards natural gas prices on a global basis, including in the United States. We see increased demand for natural gas in terms of electrical generation, in terms of chemical fabrication. We see increasing markets for liquefied natural gas on a global basis. But we also see an industry that has enough supply, and this is important, that fabricators can rely on it. One of the things that constrained demand for natural gas, industrial demand for natural gas in the United States 10 years ago, was people thought we were going to run out of the stuff. So you didn't want to build a chemical factory if you weren't going to have feedstock. You didn't want to convert a coal-fired plant to natural gas if you didn't think you were going to have feedstock. Ironically, the ample supplies that we have in the United States are stimulating demand. So we see natural gas as an extremely healthy market.
What's interesting, most people I think don't understand the connection between alternative energy development and expansion relative to natural gas. That's interesting.
That's an
Mm.
important point, Chris.
Now, on the alternative energy front, it's such a politicized area. It's difficult to separate fact from fiction. What do you find particularly intriguing within alternative energies?
Well, I made a real mistake in alternative energy 10 years ago. I thought the fact that it wasn't economically feasible meant you couldn't make money on it. I should have remembered P.T. Barnum. Uh, I should have remembered that there's a sucker born every minute. And the truth is that there is an enormous political constituency for wind and sun. And the consequence is that although it isn't directly competitive in terms of generation with stuff like coal or gas, it's so politically correct that, as an example, here in Southern California, our local utility pays up to 22 cents per kilowatt hour for sun, solar energy, when they were only paying 6.2 cents a kilowatt hour for nuclear energy. What that means is that power purchase agreements are being signed that give utility scale producers of wind and solar an 11 or 12% unleveraged internal rate of return and a 16 or 17% leverage rate of return, not because it's an economical form of energy, but rather because the legislature has chosen to rape the ratepayer and the taxpayer. I should have recognized that investing in government stupidity rather than markets is probably a better speculative strategy. I'm only being slightly cynical.
Well, let's go back to a commodity that's not loved certainly by the mainstream media or lobbyists. That's uranium here. And
Right.
you had mentioned earlier about the supply side of uranium. And in the news, we mainly hear about the demand side as far as falling off, whether it's Germany or Japan. But what else do we see, and what's the long term prognosis for nuclear demand?
Well, Chris, as you know, the uranium business has been very good to me. Um, it is over time very, very predictable. And I love questions where the answer begins with when, not if. There is zero doubt about the fact that we are using more uranium today than we're producing. So we're using up existing stockpiles. And that's a very good thing because some of the stockpiles that we're using up are demobilized weapons grade uranium. And it's much better to run light bulbs than fry cities. Uh, the real question, the first question is when does the Japanese nuclear fleet come back online? The Japanese, in terms of feedstock, are paying about 4 times as much for natural gas as they would be paying for uranium. So, from my own point of view, it's a matter of time before the Japanese nuclear fleet restarts, but I don't know when that time is. Longer term, the Japanese become less relevant because of new plant nuclear construction, primarily in the Middle East, in India, and in China, but also to a lesser degree in Korea and Taiwan. The truth is that we are making the stuff for $60 or $65 a pound and selling it for $40 a pound. We have done this once before in my career. I remember at the beginning of the last decade when nobody cared about uranium because it had been involved in a 20-year bear market. In fact, the price of uranium then was $8 a pound, but the equation was the same. We made it for 20 and we sold it for 8. We lost $12 a pound. And the upside in the uranium price from $8 to $120 was the wildest bull market I've ever lived through. But the market in the shares was even more wild. The poster child for that, of course, was Paladin Uranium, an Australian stock which went from a low of, I'm not kidding, a penny to 10 Australian dollars, 1,000-fold return, not 1,000%, 1,000-fold return in 4.5 years.
Well, that is incredible. What's great about uranium, obviously, is that the plants are completely insensitive to the price. When you spend hundreds of millions of dollars on a plant, you're not really concerned whether or not your feedstock is $40 or $100. It's immaterial to the overall cost of operating the plant.
That's absolutely correct, Chris. We like to joke that the legal bills are substantially higher than the feedstock bills. As you point out, a modern million-pound plant probably costs $6 or $7 billion to build, and consumes at today's prices $35 million a year worth of yellow cake. The truth is that the feed is an insignificant part of the total cost of producing power, which means that demand relative to price is completely inelastic.
Well, Rick, thanks for going over the landscape of energy commodities here. It's been very instructive. Thank you very much for your time.
Well, it's a pleasure. It's always nice to talk to another free market oriented financial services guy.
Absolutely. Thank you, Rick.
Pleasure, Chris. Thank you.